Hi, my name is Dan Fowler, President of the Apartment Owners Association of California. We have two great programs for you today. Live stream. Welcome, by the way, to the AOA live stream. Two programs that we have lined up for you today. I'm sure you will discover at least one idea that'll help you make and or keep more money than ever before. These are paid advertisements that we'll be bringing to you, and their goal is the same as AOA, that you get ideas from them that help you make and or keep more money than ever before, and or make your job of managing your building easier, more profitable, and more enjoyable. That enjoyable part is getting harder and harder as the politicians pass more and more laws. It was certainly hard on one man this month that we're reading about. He had about $17,000 in back rent. He's 67 years old, retired, disabled, dependent upon the property for the income, dependent upon the income to live. And this tenant would not pay rent because of COVID. That's pathetic, folks. You and I know that. We know it's against the law to force you to provide labor and free rent. Free labor and free rent. Does that ring a bell? Having to work for free and having the politicians force us to do that? They should go without pay and work for free also, if they think that kind of a philosophy is good. Personally, as you know, we don't believe in it here at AOA, and in all probability, if you're listening, you don't believe in it either. And with this kind of a thing happening, this particular housing provider had to sell his home. He says, it's just better to sell my home. I don't know when I can collect the rent. I'm certainly going to sue that guy in small claims court for the $17,000 that they owe, but I don't know when it'll be paid. So he sold his house and took about a $70,000 loss. I wonder if the mayor of your city or the governor would like to reimburse him that $17,000. I don't think so. I don't think they have any idea of doing that at all. They stole the money from him and forced him to give it away. They've used it to buy the votes of the people receiving the benefits. And that's what it comes down to. These politicians have one idea, one goal in mind, and that's to get reelected because they want the power. They know how to help us to live and tell us how to live our lives and tell us what to do. And so this is what they're after in doing that. We have an opportunity right now with the governor being, looks like he might be recalled. I think they'll listen to your letters a lot more today than any other time. So I'm asking you to do a couple things. Number one is to write the governor a letter. Tell him that you're tired of free labor and free rent. It's not fair. It's unconstitutional. He knows it. He knows that it's unconstitutional. Why does he keep doing it? Why doesn't he represent us and fight for us and fight for the property rights that he knows should be given? So let me put his address up on the screen for you so you'll know who to write. You want to write the governor, Gavin Newsom. And again, remember, folks, he's going to listen to you today. He's going to listen more. He's going to read your letters with this recall thing going more than any other time. Please write. Don't sit there and say, well, somebody else will write a letter. They won't. Okay? We're depending upon you to write the letters and do that. Number two, again, we're looking at a major lawsuit. We have accumulated over $250,000 to pay toward a lawsuit. We need another $250,000. We need each of you to send in at least $1,000 if you're providing housing, if these laws are affecting you. So, well, they don't affect me. They don't affect you today, but they're coming after you. They want your property, and we don't have time to go into the detail how they're accumulating properties and taking it away from our industry with their laws and new laws that they come up with. So we're asking you to donate to the lawsuit. Like I say, at least $1,000, $100 a unit if you're a small owner. Contribute to this fund. Send your checks in to the AOA Political Action Committee. Make your checks payable, AOA Political Action Committee, or AOA PAC, and send it in to the home office of the Apartment Owners Association, better known as AOA. And send this in right away, and as soon as we have about $500,000, and that's our goal, We will go in together with another organization filing lawsuits, maybe that have already gone a little bit of the way and have shown that they can do it, and that they have lasting power, and they will have a goal to go all the way to the Supreme Court. Again, our lawsuit has a better chance of winning today with 3 new justices, 3 new people on the Supreme Court who don't believe in redistributing wealth. At least when they were appointed, they didn't believe. Sometimes these people change after they get the power and after they get the position that they've wanted all their life. However, we do have 3 new people. Our odds of winning a case are greater now than ever before. In other words, the money we spend is going to be better spent, and we have a better chance of success than we ever have before. And so we're asking you to donate at this time. We've had some precedents set. A major lawsuit was won in Texas here just this last month. They got an order down. That came down. And let me read to you. The federal court's decision sets critical precedent. And it's that precedent that we have now that we've never had before that we can use, in addition to the extra judges. If eviction moratoriums imposed by the federal government are unconstitutional, the court ruled. This means that even Congress cannot come in behind this decision and legislate. It's just flat unconstitutional. So we've got to carry it all the way to the court. We've got to put these politicians' feet to the fire, and we've got to make them realize that what they're doing to us is unfair. Use the words free labor and free rent. Do you really think, when you're writing these letters, ask the politicians, do you really think that free labor and free rent is my obligation? Or is it the obligation of all the people if you're going to do it? I think it's illegal even if it's all of the people, but it's certainly more fair and even if you get it paid by all the people instead of just housing providers. We've already provided the biggest solution to this housing problem that the politicians have created with their rent control. Write your letters today, send in your donations today, and we'll get to work for you, representing you. You certainly could not file a lawsuit on your own for $1,000 or $10,000, whatever you can afford to donate. Do it today. Write your letter to the government today. It's a real privilege to introduce to you Jeff, and he'll be introducing our speakers. And again, get a pencil and paper and write down those ideas, because you're going to get some ideas to help you make and or keep more money than ever before. Jeff, it's all yours.
Welcome, everybody. Thank you so much for joining us. We're just really thankful for Robert Hall and Associates. They're sponsoring our program today. They are your tax professionals. You'll want to use them if you're going to be prepare your income taxes. And they have just incredible resources, wealth of knowledge. They have over 500 5-star reviews, and so they really take care of all of their clients, so you'll want to listen to them. They've been in business for almost 50 years, and so with that kind of experience, they have the leadership and they have the young guns that are grinding it out with all the changes that have been happening with tax law. So they are prepared for you. So I want to say just a special thanks to them for putting this on. So it's not just that it'll be top tax secrets for the successful investor, but you're going to hear it from successful investors. You're going to hear it from people that really know what they're talking about. My name's Jeff Fowler, the Vice President of the Apartment Owners Association. And again, it's really good to have you here. We're one of the largest individually organized groups of apartment owners in the state. And that's a lot because of you guys. And it's just amazing to see all of the members renew, and it's great to interact with you. We really miss having the $1 Million Trade Show, and we miss having the seminars locally from San Diego all the way up to Alameda. We miss having those with you and having the interaction. At least you can see my face, but man, I wish I could see yours. And so we're looking forward to that when things can open back up. But until then, and here we are. And I just wanted to mention that one of the major benefits that you have as an AOA member is having access to an advisor to give you property management advice. And, we have the forms, but they can kind of tell you what your options are and how to use them. So I want to encourage you to give your advisor, your local advisor, a call if you need any help, and keep yourself out of trouble. We're here to keep you in the know, and that's what our job is. And also, I do want to mention that we are preparing some property management software. So if you're interested in a little beta testing, you could give me a call. Just call AOA and ask for Jeff, and I could give you a little introduction to that. That will be launching shortly. And anyway, today I'm going to I want to remind you to just hold the questions till the end, because he may answer your question. You're about to hear from a fire hydrant, okay? This guy's going to give you a lot of information. Fortunately, it's being recorded, and you can go back and look at it. If you're looking on the AOAUSA.com website or Facebook, you can go to YouTube later on and watch the recording again. So there's no pressure to get every single thing this time. You can listen to it again. You can subscribe on YouTube, on Facebook. You can subscribe and you can hit the notification bell, and then whenever we have a live stream, you can be notified and stay in the know on that. And we also have an email newsletter that we send out. If you would like to get those notifications, what's happening in the industry, what things are going on, then go ahead, go to the AOAUSA.com website. At the bottom, if you scroll down at the very bottom on the right side, there is a box there for you to subscribe, and if you subscribe, we'll send you information that relates to you. You'll see that you put in your zip code. That's because we want to send you relevant information. If you're in Los Angeles, you probably don't want to hear about Alameda, and if you're in San Diego, you don't want to hear about Tri-County. So for that reason, you put in your zip code and we give you the information that matters to you. Today, as I mentioned, this is a nationwide firm, and so they're going to be able to help you, and it's going to apply to everyone, no matter if you're in the state, and even if you're out of the state or you have investments out of the state, they're going to be able to take care of you. And so the speaker today, he has 17 years in the business. I was just talking to him a couple minutes ago. He's working late nights and really, really working hard for all of his clients. So I know that he provides great customer support. He's an expert, and he's a federally licensed enrolled agent. He's a senior tax consultant with 17 years of experience. He got the Glendale's Reader's Choice Award for personal financial, best tax preparer. And so he's excellent, and he's a fire hydrant, and so it's my pleasure to introduce to you today Tony Watson.
Thank you so much, Jeff. Thank you so much, Dan, for having me back. Thank you, everyone at AOA, for always involving our firm and myself in your educational seminars and webinar division. I can't tell you enough how important it is to educate yourself, especially in today's world, in today's economy. The amount of information that AOA provides for their clients is second to none. And so we are just very privileged, feel very honored to be a part of the AOA educational group and fund, and to be able to bring this information to you, for me personally, is very much an honor and a privilege on behalf of Robert Hall & Associates. My name's Tony Watson, and thank you so much for the wonderful introduction, Jeff. It is true, 17 years working as a tax professional locally here in the Southern California area, servicing all 50 states across the U.S. 2020's tax year was very unique. 2021 is off to a really good start for our firm. We've been able to assist and help many clients, both new and old, with tax preparation and tax planning. And we're seeing some great results on the individual and business side of tax filings this year. We did a lot of planning last year. I'll be real upfront about that. We knew that 2020 was going to be a very unique year, so we spent the third and fourth quarter of 2020 really honing in on the planning aspect of tax preparation. And so a lot of our clients coming in right now during tax season, they already knew what the results were going to look like because we had put a plan in place. And so one thing, if there's anything that you get from today's webinar, from from my portion of today's webinar, just understand that there is power behind planning. And failing to plan is ultimately planning to fail. Always remember that when dealing with anything, financially speaking, in your own financial world. So today we're going to talk about the top tax secrets for the successful real estate investor. And this can be an individual who owns long-term rental investments. This could be somebody who manages properties for a living. This could be an individual who sells property and makes commission income, or a hybrid of all three. Just like myself, I prepare taxes, I teach people about taxes, I teach people about real estate and taxes, and I also invest in real estate. So I do very much practice what I preach, and so all of the professionals that you work with should very much be practicers of what they preach. But today's top tax secrets for the successful real estate investor. And once again, my name's Tony Watson. I've been with Robert Hall since day one. Week after I graduated from college, I moved to Los Angeles, started working with Robert Hall. And day 2 of preparing taxes, Bob Hall told me, he said, Tony, it's not how much you make. It's not really even about how much you spend either. It's about what you get to keep. And so I tell my clients that tax preparation is equally as important as wealth retention. In fact, they go hand in hand. Right? If you can plan ahead to pay less tax, that is planning to retain more of your hard-earned wealth. Now, I know that it's kind of difficult to see a lot of the tricks of the trade in today's economy, especially with the printing machine going 24/7 at the government level. But at the end of the day, we do see light at the end of the tunnel. We're being very positive about moving forward through 2021 and looking for every angle that we can maximize to retain wealth for our clients and not overspend at the government or the state level. So always keep in mind that we are big players, tax advisors. We're big players in your financial world. And so always be in contact with your tax advisor, always have a plan in place so that when you do go to file your taxes, that you're not surprised by the results. Always know ahead of time. Let's face it, not all of us wish that we could see the future, but through proper tax planning, this kind of seeing into the future may be actually a really good thing. So always keep that in mind. Out of 17 years of preparing taxes, I'm also the keynote speaker for Robert Hall & Associates. Very honored, very privileged to be here today. And I personally, in my clientele list, just out of my 1,200 tax returns that I file roughly each year, 15,000 as a firm nationwide. I personally have clients that manage and own and work in the real estate industry and business industries and own over $150 million in assets, as well as business transactions on a year-to-year basis. So at the end of the day, you also want to work with somebody who understands your industry. Here in Los Angeles, there are very much firms that work specifically with entertainment clients. There are firms that work specifically with real estate clients. At Robert Hall & Associates, I'll be real transparent. A majority of our clients are real estate investors, but also business owners. And so we handle a wide range of individual filings and business filings. And so there are a lot of situations that we have seen that other firms may not be aware of, and angles that you can take in certain industries that will help you, once again, retain wealth and pay less overall tax to the federal government and the state of California. Before I forget, because I know that at the tail end we're going to open up for Q&A, I did want to mention that we do offer free consultations. Normally they are in-person free consultations, but because of COVID, we're doing everything digitally, either by Zoom or FaceTime or some way to connect digitally, or just straight up old school by phone. But this is really important for our clients, our current and future clients, to understand that we are available year-round for you. Just because April 15th tends to be a deadline, we don't leave town on April 15th. We might take a couple days off, but we're right back in the office ready to hit the ground running for 2021 planning. So feel free to reach out to our office at any time. If you have a smartphone device, you can actually open up your camera, wave it over the QR scanning code on your screen, and that will automatically prompt you to sign up for that free consultation. I will remind you about this again towards the end of the presentation today. So most importantly, let's talk about some really unique and key deductions to maximize in 2020, because obviously 2020 is over and it's all about organizing 2020's information to file in 2021 for last year's filing season. Some of the top tax deductions that I've seen over 17 years of preparing taxes, 50 years of Robert Hall & Associates being in business, we've seen these top 5 tax deductions more commonly on business and real estate tax returns. Now, obviously, when you have a vacancy, you want to market, you want to promote your business, your property, your vacancy. And so marketing and advertising and promoting expenses tend to be one of the top 5 write-offs. Number 2, supplies and equipment, and this happens to be one of my favorite write-offs overall, because equipment has a very, very low risk for audit, number one, and number two, we have options of how to deduct equipment expenses. For instance, how many people do you know in today's day and age who can do business or do what they do professionally without a cell phone or without a computer? The federal government knows and understands that these are some of the most common deductions that business owners and real estate investors will have written off on their individual returns. Equipment, for instance, like a computer, has a 7-year lifespan. So you have the option of either spreading the deduction out over 7 years or making an election called the Section 179 election and accelerating the full computer expense, taking it all in 1 year as a write-off. It's not always necessary to take the deduction fully in this year, especially if you already have other expenses wiping out your profit. Mortgage interest, property taxes, insurance, travel, HOA dues. So if you get that profit down to zero, why would you further throw yourself into a loss if it's not needed? If the tax rate is already very low, if you've wiped out your overall liability, let's carry forward this expense into future years. Having the option to do this is an advantage to you as a taxpayer. And so these are great, unique situations for your tax advisor to map out for you. Hey, you went out and bought $3,000, $4,000 in new equipment because you've been working from home. It's more efficient that way. You're not going into the office anymore, not going into your place of work. And so all of this equipment, great overall write-off. So computers, cell phones, tablets, Wi-Fi routers, hotspots, office furniture, desks, chairs, filing cabinets, you name it. Anything that has a tangible feel to it is a depreciable asset. And so you want to understand the options of how to deduct these expenses. Number three would be car and truck expenses. Now, car and truck is a very unique write-off because we have two options here. We can either take off the actual car expenses or mileage. And actual car expenses would also include depreciation on a vehicle. Now, these can be some of the largest write-offs for business owners on an individual and business return, especially as of 2018. Back in 2012 and 2013, there was something called bonus depreciation written into the Internal Revenue Code that allowed business owners to fully deduct certain weight class vehicles. A car that weighs over 6,000 pounds, for instance, can qualify for something called 100% bonus depreciation and end up on your tax return as a dollar-for-dollar adjustment to income. Now, not everybody will qualify for this benefit, meaning that if you go out and you buy a $60,000 Chevy Silverado because you're moving product and building homes and managing your property with supplies and new appliances, so you buy this truck and you use it for 100% business, and at that point, it may qualify as a 100% write-off for you, depending on how it is structured for your business. Obviously, if you only have one vehicle, we need to separate it between business and personal use. But in certain instances, if you own a business and you acquire this vehicle for business use, solely for business use, and you have another vehicle used for personal use, this vehicle, the $60,000, $70,000 Chevy Silverado, could potentially qualify for a 100% write-off. Even if you finance it, that's the kicker here, is that you don't have to buy it outright to get this write-off. You put $2,000 or $3,000 down on the vehicle, you finance the rest, and you still qualify in certain instances for a $60,000, $70,000 dollar-for-dollar federal write-off. California does not conform to this part of the Internal Revenue Code, so the federal government is where you truly receive all of this benefit. Ask your accountant about this benefit. Ask them how you can accelerate depreciation on your return to help further reduce federal income tax liabilities. It is not going to be right for everyone. I have to tell you that everyone's tax scenario, everyone's tax filing, everyone's tax return looks different. There is not going to be a single return out there that looks exactly the same as yours. You know, you're married, so if you're married, you have the same tax return. So, of course, that's the same tax return. But you and your neighbor, your coworker, your family member, you will all have separate and different and unique tax returns. So just because your neighbor qualified for this benefit and says, hey, you should go out and buy this $70,000 vehicle, do not do it because your neighbor did it, okay? Do it because a licensed tax advisor advised you of the benefit of doing this. Always remember that. Get your advice and get your planning strategies that you're putting into place. Get these strategies and these planning approaches from a licensed tax advisor, not anyone who is not licensed. I can't stress that enough. So number 4, legal and professional fees. A very, very unique deduction for a number of reasons because starting in 2018, a lot of things changed under the Internal Revenue Code. One major change was taking away this deduction from W-2 wage earners. But for the self-employed individuals, the real estate investors of the world, legal and professional fees is still a great dollar-for-dollar write-off. So make sure that you understand, or that your tax advisor understands, that the limitations as of 2018 could affect or impact certain individuals, but not everyone. If you are a rental property owner, a property manager, a property flipper, a realtor, you are a business owner whether you like it or not. And business owners under the old and new Internal Revenue Code receive 99% of the tax benefits, still currently under the new tax reform bill. What really changed in 2018 was the tax benefit for write-offs on the W-2 side of things. So for the teachers, the firefighters, the police officers, the accountants who work for accounting firms. So as W-2 wage earners, we are no longer allowed to deduct some very unique business expenses like cell phone and travel and legal and professional fees and auto and truck. California will still allow us a little bit of a write-off, but on the IRS side, it doesn't matter if you are a W-2 wage earner. But if you're a rental property owner, self-employed real estate investor, you are still allowed a lot of these great write-offs. So make sure that you're maximizing every write-off that you can on your individual and business returns. Last but not least, property deductions, all right? Property deductions are very unique because we could be talking about the in-home office write-off. We could be talking about the mortgage interest deduction on the Schedule A, the property tax deduction on the Schedule A. There are a number of write-offs that we can take pertaining to properties themselves. Now, when you rent out a property, the deductions change, right? When you rent out a property, pretty much everything that pertains to that rental investment is going to be a dollar-for-dollar deduction. And where people start to misunderstand the rental investment side of the Internal Revenue Code is who is allowed not deductions on a property, but who is allowed a loss deduction from a rental investment. And this is a very unique part of the Internal Revenue Code. A lot of these really unique real estate professional related parts to the Internal Revenue Code, they've been around since 1962. So when you hear about the wealthy of the world taking advantage of real estate sheltering benefits on their returns, understand that this is not something that's new. This has been something that's been around since the early 60s, okay? And if you are a real estate professional, you will receive every single benefit built into the Internal Revenue Code, because when you check that box on your return, which we'll get to in a couple slides and talk about the real estate professional election, you essentially open up a whole new world of additional tax sheltering benefits. But if you are not a real estate professional, you are not allowed some of the full deductible benefits of real estate related activity losses. And that all depends on your adjusted gross income. So I'm not going to go into too much detail about this today, but if you make above $150,000 adjusted gross income and you are not a real estate professional, you will be limited to the amount of loss write-off you're able to take through your real estate investment properties. You'll still be able to deduct expenses to the extent of rental income collected. Let me give you an example. Let's say I rent out a property, I bring in 20 grand in rental income. I can write off in any case, whether my income is high or low or zero, I can write off expenses to the extent of rental income. So in this case, I can write off $20,000 in deductions. Well, let's say that I'm a high income earner through all of the real estate investment properties that I own, and my spouse is a doctor, and she's got a $1 million W-2 as a brain surgeon, right? So obviously our income is way above this threshold, so our real estate related losses may be limited unless I or one of us is a real estate professional. So either my spouse or myself, as soon as one of us elects to be taxed as a real estate professional, any losses through real estate related investments are now going to be allowed as dollar for dollar adjustments to overall income. If your eyes are rolling back in your head and you're thinking, man, this is insane, I didn't know about any of this, or I'm very confused, do not be afraid. You are not alone, okay? The tax code, if it was simple, 1, I'd be out of a job. 2, everyone would know how to save money on a tax return, and our industry would be non-existent. And people would essentially pay no tax if they knew all of these tricks of the trade, how to make certain elections, how to deduct certain things. And so it's really important for you as you build your portfolio, as you start to build wealth, that through proper tax planning and working with the right advisors, that you also retain a majority of this wealth that you're building for yourself. Against all odds with the federal government and the state of California, with everything that's changing nowadays, make sure that you are taking an aggressive stance, a safely aggressive stance, by knowing the chess game to play with the IRS and the state of California. The code is written for a very specific reasons. It is guidelines to how to file a return. But there are certain parts of the Internal Revenue Code that might work out to your benefit but not give your neighbor or your coworker the benefit. And how will you know about this unless you work with a licensed advisor who understands the code inside and out? And that's exactly who Robert Hall and Associates are. That's who we are. And we've been open for 50 years doing this day in and day out for the last 50 years. Myself, 17 years, obviously, but Robert Hall and Associates have been around for 50 years. So we do know every angle that is out there, and obviously there are some changes on the horizon. So when those changes actually settle, when the dust settles around those changes, we'll be right back here giving you a full update on the Biden tax administration changes. So obviously property deductions, we're going to get back to that in a couple slides here, but I did want to mention just for the car, the automobile quandary, because some clients, or some individuals in our webinars, they'll say, well, I want to go back to the car and truck expense really quick because I usually take mileage, but I am in the market for a new car. When does it make sense to buy or lease a vehicle for business use? And I want to mention just really quickly that I am not the kind of tax advisor that will send you out to buy a car or lease a car solely for a tax benefit. That is not me. I'd rather you buy real estate. I'd rather you improve your own property. Those are appreciating assets. Those are great investments to park your money in. A vehicle is a depreciating asset. We all know this. But at the end of the day, for the individuals actually in the market to buy a car or to upgrade a car, because let's say your car was in an accident or your car was on the fritz of just breaking down. It's an old car. You put 300,000 miles on it, and now you're in the market for a new one. You want to be safe on the freeway and driving to all of your listings and your managed properties. So you're in the market actively looking for a vehicle. In this case, this is a great conversation to have with the tax advisor. If you're already looking for the vehicle, how do we figure out a way to get a great write-off for this lease or this purchase? Well, I can tell you right now in California, we tend to see more people leasing vehicles than purchasing. Just because maybe of a lifestyle choice, I don't really have a full-blown answer as to why more people lease than purchase, but it could be for a number of reasons. Once again, lifestyle choice, ease of maintenance and repair. You turn it in, they give you a loaner car. Whatever the idea is, leasing in most cases is going to be a great write-off for business owners. Purchasing, however, will be a much larger upfront deduction versus the lower, more consistent write-off of leasing. So starting in 2018, the federal government brought back this bonus depreciation write-off that states that if the vehicle weight class is over 6,000 pounds, gross weight of the vehicle, it potentially qualifies for this 100% tax benefit. Don't worry if you're thinking, well, I'm not going to buy an SUV, I want to buy a hybrid. Understand that if it's under 6,000 pounds, you still get a nice write-off for it. It's just instead of being 100% tax deductible on the IRS return, you are only allowed up to about $18,000 in the first year write-off of the value of that vehicle. Now, if you paid 26 grand for the vehicle, you get 18,000 in the first year in this instance, and then the remaining value of the vehicle tapers off over the next 5 years, which is the depreciation lifespan of the vehicle. So you don't lose it, you just don't use it all in the same year. Whereas the weight class, if it's over 6,000 pounds, you get it all up front as a full dollar for dollar write-off. So make sure that you have this conversation with your tax advisor before going out and leasing or purchasing your next vehicle. Once again, do not go out and do this simply for the write-off. It does not make sense financially for you to take on a vehicle payment solely for tax savings. Sure, you will get the tax savings, but that is not what I'm trying to tell you here. I'm saying that if you are already actively looking, have the conversation with your tax advisor before making this financial decision. Now, let's hop on to the next, probably most commonly asked question in the tax industry. Out of all of my real estate related forms on my individual return, what is going to be my most audited? Obviously, if you work from an office location in 2020, you got moved home, right? You didn't have an office location in most cases to work from. Our office closed down for a couple months. So I moved home last year in March, I think, first week of March, I started working from home, and a very unique time for a lot of business owners, right? So instead of having the brick and mortar, the comfortability of working from my own office, I was working from my in-home office, and my 2-year-old knew that I was working from home every single day. And aside from it breaking my heart, him wanting to play with me all the every day that I was home, it was still very difficult for a lot of individuals, and I'm not complaining. Listen, I'm very blessed to be in the situation that I am, but just understand that 2020 overall for business owners in general was a very unique year. And so they are still very much afraid of certain deductions to take, even though some deductions became more common because of the pandemic than others. And so when we talk about the most audited deduction, the number one most audited form on an individual business tax return is going to be that in-home office write-off. Prior to the pandemic, it had close to a 70+% chance for audit on a year-to-year basis. Now that form is called an 8829 form, and that is the form that you file when you actually have a space inside of your home to work from. Now, some individuals think that because of the pandemic and people being forced to work from home, that the in-home office deduction will have a lower risk for audit. We don't have any figures on this just yet. Hypothetically speaking, I would assume that it has a lower chance for audit because the IRS knows that people had to work from home. But at the same time, the IRS has never really honed in on the in-home office deduction because they don't think it is a legitimate write-off. They don't think that the allocation is reasonable of your office space inside of your home. That is the true kicker for the increased risk for audit on the in-home office deduction. So I've had a lot of clients saying, well, because I've had to move home and work, I've converted my 2-car garage into my office space, but I still have the room that I use inside of the house as an office space, and then I have the closest bathroom. So, 45% or 50% of my home is now an office. Well, as legitimate as that is, when you put 45-50% of your home as an office space, the government knows that the in-home office deduction is ordinary, necessary, and legitimate. So it checks off all the necessary requirements and boxes. But at the end of the day, are you being reasonable with the allocation? And that is what gets people in trouble, is the reasonable nature of each of your write-offs. Most deductions for business owners will be great dollar-for-dollar adjustments outside of entertainment, which is limited on the IRS side, and mileage, which is at about 57.5 cents per business mile. Under the Appropriations Act, starting because of the pandemic, meals actually potentially can be 100% tax deductible. In the past, prior to the pandemic, meals were limited to 50%. But in order to support or in an effort to support the restaurant industries, the federal government under the Appropriations Act has converted the 50% limitation into a 100% tax deductible benefit. Now, there are some check boxes that you have to mark off there, but for the most part, meals is going to be a pretty nice write-off for individuals in 2020 and 2021. Talk with your tax advisor before taking 100% of your Postmate and Grubhub deliveries on your return, though, okay? Have this conversation beforehand. But a lot of changes coming out of the pandemic. And so once again, because everybody was working from home, most people were working from home last year, they naturally think, well, a larger percentage of my home is going to be a write-off, but people are still fearing taking it as a write-off because of the increased risk for audit. I'm here to tell you that there is a whole part of the Internal Revenue Code that allows you to deduct part of your home as an office if you truly have a space inside of your home that you work in. So do not be afraid of this ordinary, necessary, and legitimate write-off, but do be aware that if you are not being reasonable with the square footage, yes, the 8829 form prior to the pandemic, during the pandemic, and even after the pandemic will still have a slightly higher increased risk for audit, simply because of not the legitimacy, but of the reasonable nature of the percentage of your house that you're trying to write off, okay? The second most audited form on an individual return is the Schedule C, which for the rental property owners listening in today is not the form that you're filing, is it? You file Schedule E's for rental investments. So if you have been told that your rental property forms run a high risk for audit, that is actually pretty far from the truth. Schedule C's, which are sole proprietor returns for property managers in particular, though those are the individuals who file Schedule C's in most cases. Schedule C's tend to be the second highest audited form on an individual return. And it's only because they are businesses. Now remember, in 2018, if the government took away all write-offs for W-2 wage earners, naturally the risk for audit for W-2 wage earners goes down because they're not really deducting anything, right? Well, if nothing changed for the business owner, and business owners are still allowed to deduct most expenses dollar for dollar, barring a couple limitations here and there, then the in-home office and the small business forms will be the highest risk for audit items. Schedule E's have a very low risk for audit because between the two forms, the Schedule C, which is the property management type form that you'd file, and the Schedule E, one form out of the two pays 3 types of tax, and the other form only pays 2 types of tax. Schedule E's, which are rental investments, they only pay federal and state income tax because it's not self-employed income, right? Schedule C's will pay federal and state income tax, but on top of the 2 types of tax, federal and state, Schedule C's will also contribute to Social Security and Medicare, which is self-employment tax. So the government focuses more of their time on Schedule Cs because they know that every write-off that a property manager takes, it not only saves them federal and state income tax, but it also saves them from paying 15.3% in Social Security and Medicare tax. So you actually save more per dollar in write-off on a Schedule C than you do on a Schedule E. So just a little bit of an insight into these two forms and why the Schedule C tends to have a higher risk for audit than your Schedule E form. But Schedule E's are great overall forms from an audit standpoint. They are forms where you're going to put basically every expense that pertains to your rental investment as a dollar for dollar write-off against that Schedule E income. Coming out of the pandemic and under the CARES Act, there is a certain amount of improvements that you can accelerate now under the CARES Act of 2020. And this allows you to take QIP, Qualified Improvement Property, potentially at up to 100% or 15 years rather than the pre-pandemic rate of 27.5 years. See, if I own a rental investment before the pandemic, I was allowed to make improvements to my property, and in most cases, anything that was structural, not just general maintenance and repairs, anything that was structural had to be deducted over 27 and a half years. Coming out of the pandemic, I'm able to accelerate that 27 and a half years down to 15 years, or if certain qualified improvement property requirements are met, I potentially could even write it off at 100% deductibility. I have to be very vague about this part of the Internal Revenue Code in a webinar because it really all depends. We need to sit down and look at your specific expenses, figure out what could potentially qualify for QIP improvements and what is not, what is still structural, depreciated over a certain period of time. So make sure that you are not just throwing 100% of your write-offs on your Schedule E saying, oh, well, the QIP property is 100% tax deductible. It still will land on a specific form, not your Schedule E, but your depreciation schedule form. And there are certain methods to accelerate this write-off under the CARES Act and the new Internal Revenue Code. So once again, very important for you to work with a licensed advisor who understands a majority of these changes. Is a Schedule E highly audited form? No, not compared to a Schedule C and the 8829 form. So it's also very important for you to know where to maximize the aggressive standpoints on the safely aggressive standpoints on the individual and business side of things. Now, I'm not going to touch too much on this slide, but I do want to mention that coming out of this pandemic, we've had a lot of questions about whether or not incorporating is right for them, or if an insurance policy covers them from head to foot, front, back, side to side, or if they just need a trust. Just take this away from this slide, that all three of these options provide a completely separate benefit to you as an investor. Number one, you absolutely need a good insurance policy, right? You talk to any insurance rep, they're going to say, hey, insurance is going to protect you dollar-wise. Right? If anybody is suing you or pursuing you, or if you're pursuing anybody, or if you're in a car accident, you have insurance, liability insurance, car insurance, health insurance in case something happens. Insurance is there and in place to pay out a settlement in case an unforeseen event happens. That is what insurance is there for. A corporate entity like an LLC or an S Corp or a C Corp, those entity structures are meant to separate business from personal assets. So asset separation equals asset protection and vice versa. A trust does not protect you in most cases. In some cases it might, but certain and specific trusts could protect you from litigation. But most of the time a trust is really to protect you from the state where you own most of your assets or reside. So it's to protect you from probate. Right? So each one of these options provides you a separate benefit. Insurance is by far the most important. An incorporated entity might be necessary, but only per the advice of a legal advisor or a tax advisor who understands a little bit of the incorporating benefit. Not everybody will need a trust. If you don't own a home yet, if you're new to the real estate game, if you haven't made your first purchase, if you're not married, if you don't have children, if you don't have heirs to pass on your assets to, a trust might not always be a necessary point. It might not be a necessary expense for you to incur right now. But there are many types of trusts. So I can't really, once again, answer whether or not a trust is right for you until we sit down and look at your overall financial situation. But I want you to, once again, take away one thing from this slide is that all three of these divided parts provide a completely separate benefit to you as a business owner or real estate investor. Now, once you incorporate, you'll hear a couple things from tax advisors, from legal advisors as to what the benefits, the true benefits of incorporating are. Now, I want to map this out specifically and especially for property managers listening in today. If you are that property manager where you've been working in the industry for a very long time and you manage several properties, so your cash flow tends to be a little bit higher than somebody just entering into the property management game, you may have been approached or had a conversation with a tax advisor about utilizing a corporate entity to save you tax and to also protect your business separately from everything you own personally. And so you might have been pitched this wonderful entity called the 1120S Corporation. And the 1120S Corporation is in fact the only entity that can save you tax. And here it's mapped out on the screen. So I want to show you this really quick and show you how it breaks down. Let's assume that through your property management company or your property rehab company or your construction company, not rental investments, because remember, rental income only settles up with federal government and the state of California. It is not self-employed revenue. So we're really just specifically talking to the self-employed individuals listening in today. As a property manager, property flipper, self-employed individual, if you're making $100,000 in net revenue, this is after you've taken all of your expenses into account. As a sole proprietor, you would be paying, if you're not incorporated, you'd be paying federal, state, and self-employment tax on $100,000. That's a lot of money, right? So 24% federal, 8% to 9% state, and then you've got this nasty 15.3% of self-employment tax, all on $100,000. Once you hit certain levels of net revenue, though, a conversation should be had with a tax advisor about whether or not incorporating yourself will save you more than it costs you, will allow you to retain more of your wealth by paying overall less income tax. And so net revenue at about 100 grand, this is how it maps out. Let's assume that after all of your expenses, deferred comp, car purchases, payback for rent and in-home office deductions, let's say that your net profit is 100 grand. If you are filing as a corporation, you are no longer self-employed. So therefore, you have to put yourself on payroll. This is a very unique part of being a self-employed corporation filer. And so the magic really happens in part 1 and part 2, where you calculate your net revenue, you figure out what your reasonable salary is as an employee of your own corporation, and then you get to fully deduct yourself from your company's profit. So $100,000 minus your $40,000 W-2 gives you a $60,000 leftover profit. Now, what you've effectively achieved in this calculation, once again, barring if the numbers actually map out this way, and it can be as low as about $45,000 to $50,000 in net revenue, what you've just achieved here is proper tax avoidance. Remember, tax evasion is illegal, proper tax avoidance is not. And so this is a great way for self-employed individuals to avoid overpaying the government in Social Security and Medicare tax, because what you've just effectively done is taken your $100,000 net revenue amount and only made $40,000 of it subject to self-employment tax. But instead of it being called self-employment tax now, it's called payroll tax, which is your contribution to Social Security and Medicare. So $100,000 minus $40,000 leaves you $60,000 left over in profit. That $60,000 will still pay federal and state income tax, but it avoids completely contributing to 15.3% of Social Security and Medicare. That alone, right out the gate in this scenario, saves you just shy of about $10,000 in unnecessary income tax. That is you retaining just shy of $10,000 of your hard-earned wealth over the past 365 days or the previous tax year. So just be aware that these are very unique games that you get to play as self-employed individuals. We've always known that the general public doesn't really appreciate the fact that the wealthy of the world pay less income tax, right? We've seen it in the media, especially over the past 365 days, with people like Donald Trump. Or the Clintons' tax returns, or you name it, politicians, wealthy individuals, they pay very little income tax because they probably have teams of people like me and other accounting firms like Robert Hall & Associates dialing in all of these numbers for them. But remember that the Trumps and the Clintons and the Pelosi's of the world, they didn't necessarily write the Internal Revenue Code. I'm sure that they have some impact on it, but they didn't write the Internal Revenue Code. They actually put the trust in their advisors, like myself. I don't do their taxes. I don't even want to touch those types of tax returns, to tell you the truth. But at the end of the day, they put the trust in their advisors to find ways, unique ways, with the built-in parts of the Internal Revenue Code that they can take advantage of. And like I mentioned earlier, I think I mentioned this earlier, listen, part of the real estate professional tax code has been around since the early 60s. Think about all of the politicians today, how young they were in the 60s, in the early 60s. There isn't any possible way that a 12-year-old or a 13-year-old could have written the Internal Revenue Code to benefit real estate investors in 1962, right? So these benefits have been around a very long time. It's just the wealthy have more access to knowledgeable advisors. They have a more expendable income to pay advisors to shelter money for them. And so this is very much an opportunity for you as well, on maybe a lower scale, obviously, but the benefits are built into the Internal Revenue Code for the wealthy and for middle America, and also for individuals who are in a little bit lower of an income bracket. You just have to know how to find these parts of the Internal Revenue Code, and more importantly, how to implement them. And it all comes down to proper tax planning. I cannot stress that enough. Put a plan in place so that when you walk into your tax advisor's office or you hop on that Zoom call with them, that you already know what the effective results are. That you already know that whatever that bottom line is, you've worked those numbers so tight on your return that whatever you're paying to Uncle Sam is your obligation in tax, right? We all have an obligation to pay tax. But through proper planning, we can pay our obligation and not a penny more than that obligated amount. Always remember that. Now, really quickly, what qualifies you as a real estate professional? It comes down to time and also revenue. Where is a majority of your income earned? Where is a majority of your time spent? And so when you check that box on your return to qualify yourself as a real estate professional, what you're essentially telling the government that you spend, number one, over 750 hours working in the real estate industry or with real estate related activities, and two, you meet a rule called the 51 rule, where you are telling the government that 51% or more of your time and 51% or more of your income is spent and earned working within or with real estate related activities or industries. So just understand that this is a very important election for a lot of real estate professionals, because it could end up opening, in a good way, a Pandora's box, right? If you imagine a Pandora's box being a good thing, this would be a good thing. It does open up a whole new world of write-offs for you as a real estate investor by allowing you to not be subject to very, very strict limitations on real estate-related loss deductions. So before you check the box like it's Wild West, where you walk into you hypothetically walk into your tax software room and start just checking boxes and lowering liability, understand what you are checking and the kind of risk and liability you run by mischecking or unchecking specific boxes, and some of the benefits that you gain and lose by doing so. Always remember that. Very, very important. Last but not least, I want to talk quickly about the 1031 exchange and some of the fears coming up over the next couple months, because literally right as I was pulling into the parking lot, I thought, right before every webinar I give, I always pull up the news, not the news, but the IRS websites and other like-kind websites to see if in the past 2 hours anything had passed that I could bring to a webinar platform. And the 1031 exchange, from what I found as I was pulling into the parking lot here at the AOA building, is that the 1031 exchange limitation or the disallowance of the 1031 exchange has not gone through, okay, as of yet. There is a lot of talk about the Biden administration getting rid of the 1031 exchange, but it has not happened as of, when I first pulled into the parking lot. So could it happen? My head is on a swivel these days. So yes, technically anything could really happen. I don't foresee this happening for everyone, though. See, what I've learned over the past 17 years is that the IRS loves to allow certain individuals a benefit and loves to phase others out of taking a benefit, meaning that once you reach certain income levels, you are phasing out from being allowed a very specific benefit. Now, I don't know if the 1031 exchange is going to be a phase-out item, but I can imagine that the government will still allow the 1031 exchange for certain individuals, but not for everyone. And the reason why I think this is the case is because the exchange industry is a billion-dollar industry. The exchange industry employs thousands and thousands of professionals. It generates a lot of revenue for the federal government. Now, to get rid of a 1031 exchange industry, in my mind, it would be cutting our nose off to spite our face as a government, at the government level, which once again, my head is on a swivel. I'm not saying that this is definitely going to happen or not going to happen. I'm just saying be ready for anything. I do not believe that anything will change for 2021. Just yesterday at about noon, we found out that the government had passed this final round of stimulus. Well, we don't know if it's the final round, but they passed this round of stimulus. Some major changes are implemented for 2020, but a majority of the changes under this new stimulus package are actually for 2021. I do know for a fact that, just as a side note, before I dive into the 1031 exchange in more detail, that $10,200 of individuals' unemployment per individual, not per couple, but $10,200 of unemployment collected for each individual in 2020 will be backed out of taxable income on the federal side. That means that if you collected $20,000 of unemployment in 2020 and you met all of the requirements, so your income has to be below, I think it's a hard cutoff at $150,000 of adjusted gross income. Once again, I have to read the 6,000 page, the support act. But if your income is below a certain threshold, you actually will be able to back out $10,200 per individual. So for husband and spouse, that you can back out up to $20,400 for a married couple from unemployment taxable benefits. So just understand that is one major change for 2020. There are some other major changes coming out of that CARES Act that just passed as well. You'll be hearing more about it in the upcoming weeks. But if you've already filed your tax return, yes, there may be a need to go back and amend your 2020 tax return. I could tell you right now that your amendment probably will not be processed by April 15th because tax season started late this year, and they are also discussing extending the filing season again out to June 15th. They have not done that, though. I want to make sure everybody understands that they have not extended the filing date as of today, as of 2 hours ago, I think. So they might have done it while I'm here speaking with you. But for the most part, April 15th is still very much the filing deadline for all individual tax returns. Now, the 1031 exchange, a very, very unique transaction. This essentially is a big part of people's retirement, number one. It's also a big part of wealth retention and growing wealth within the real estate industry. The 1031 exchange, I'm sure all of you know what it is, but just to break it down in summary, a 1031 exchange is the ability to take a fully depreciated property or a partial depreciated property and sell it without paying income tax as long as the money is exchanged for like-kind property. So prior to 2018, you could exchange like-kind anything. So you could exchange a 67 Camaro for a 69 Lincoln Continental prior to 2018 because they were like-kind in nature. As of 2018, though, under the Trump Tax Reform Act of 2018, we only are allowed now to exchange real property, which is rentals and commercial, residential. You can do a U.S. property for U.S. property. You can exchange foreign property for foreign property, but not foreign property for U.S. property or U.S. property for foreign property. You can only exchange real property now. And the reason for this is because the government knows that, hey, if you've owned a property for 30, 40, 50 years and it's fully depreciated, you're looking at some pretty sizable capital gain. And if this rental property is part of your deferred retirement and you don't have the conventional 401ks or IRAs, you need this money to survive in retirement, to live a comfortable life after your career is over, right? So the 1031 exchange is a very unique benefit for a lot of real estate investors. It allows you to hypothetically kick the can down the road until you kick the can, right? So as long as you 1031 exchange these properties for like kind, and you kick that can down the road until you pass, you never have to pay capital gain tax or depreciation recapture tax on the real estate sales, once again, as long as you are exchanging it for other like-kind investments. Now, if you pass away, right, in death, your heirs will receive what's called a stepped-up basis, and so they are going to receive as beneficiaries, hence the name beneficiary, they receive the benefit. So the beneficiaries will receive, in most cases, a stepped-up basis up to whatever the estate exemption is at the time that this loved one passes. So the 1031 exchange is really just to defer tax obligation. If the government got rid of the 1031 exchange, this would mean big tax implications for anyone who is selling property. And so this would take a lot of retirement away from individuals who are really depending on their real estate related activities for maybe a sellout at the end of the day or moving their properties out of California into another state, which also brings into another conversation. I'm not going to go into too much detail about this, but California will follow those exchanged properties across the U.S. And so if you exchanged a property out of California into Texas and you had owned that California property for 10 or 15 years, and 5 years later after you moved to Texas, you sell it as a Texas investment and not exchange the property, California has a clawback clause where they say, hey, you owned that property originally in California for 10 or 15 years, so we're going to claw back 10 or 15 years of income tax because you deferred all of that tax while it was a California investment. So just understand that there are some also very, very unique state tax legislation parts to the FTB code here in California that will follow you as you start to exchange properties in and outside of certain states. So just be aware of all of that. Your tax advisor will absolutely be able to assist with all of this information. and we're here to guide you through some of these very unique transactions from a tax perspective. So obviously the main goals with an exchange, just to list them out on the screen here: avoiding depreciation recapture. That's the big kind of nail in the coffin thing that really pushes people to exchange. To limit capital gain tax, obviously at the 15% federal, 9.3% state tax rates. If you're a high income earner, it's deferring 20% long-term capital gain, 11.3% or 10.3% on the state side, and then also potentially deferring a 3.8% Medicare tax, also known as the net investment tax that you would pay on capital gain. It's to access money as well. You could do a down leg exchange, and obviously any money that you access out of the exchange, let's say you go from $1 million property to a $600,000 property, you're taking money out of the exchange. So naturally, there will be a little bit of a tax implication for you because you're realizing some of that money and taking it into your personal account. So the goal is like kind, right? Either like kind or up leg, where you're not accessing cash. The next one was just obviously exchanging for more doors. Right? You take one Burbank property worth $2 million now, you exchange it into 15 doors in different parts of the U.S. So there are very unique ways to exchange to acquire more doors. That's a really popular thing, has been a very popular thing as well, specifically over the past 2 or 3 years. Because people are leaving California. They can't afford to live here. Reset depreciation on the up-leg exchange. So when you go from $1 million property that's fully depreciated, you have the potential to go from $1 million to $1.5 million and actually capture a little bit more depreciation, increasing write-offs for yourself, and as a result, increasing your cash flow. So once again, very unique opportunities under the 1031 exchange, part of the Internal Revenue Code. And this is absolutely something that you want to make sure that you maximize and that you talk with your tax advisor about. Okay. Now, Robert Hall & Associates, we've been around for a very long time. We are very much not only an education firm, but we are a servicing firm. We offer a number of services, obviously. Tax preparation just happens to be our main service. We offer payroll services, bookkeeping services, estate planning and trust planning services. Much like AOA, we have a lot of really unique financial referrals. But our main referral still continues to be a lot of the people in the Rolodex of AOA. So we very much like to refer our clients to everybody who's been vetted by such a great association like the Apartment Owners Association. And I feel like, because taxes and real estate go hand in hand in more than just a couple ways, I feel like the relationship between RHA and AOA is kismet. We know exactly what the AOA property managers, what the AOA property owners are looking for as far as tax write-offs, tax sheltering benefits, and tax advising is concerned. And so when we meet with a lot of the AOA clients, it's almost like it's a perfect match, right? Because we know exactly what type of investment they have and how it should be filed on an individual or business tax return. And once again, because we use referral sources back and forth, we also are advised from other professionals in other industries about unique ways to maybe properly handle an issue with Prop 19, or maybe a unique issue with a trust or estate planning session. And so there are a lot of very unique connections between AOA and Robert Hall & Associates. And we absolutely, once again, thank Dan and thank Jeff and everybody here at AOA for allowing us to come and share all of this great information with you on a quarterly basis, on a yearly basis. However much they want the crazy tax people to come back, we'll be bringing that information back to you as quickly and as efficiently as possible. But I do want to mention that if you are that individual who owns investments outside of California, we also service tax filings in all 50 states. So bring all of your questions to us. Whether you think they're overly aggressive questions or being super conservative, we'll answer them all. Okay, and this free consultation that our firm offers, it's a very unique time that you can use with our licensed professionals at Robert Hall to ask those very important questions that you might not be getting answers to with your own tax advisors. Okay, so just be aware of that. So once again, servicing all 50 states. And I did want to mention, because Jeff's gonna open up for Q&A in a second, I did once again, before I forget, I did want to mention again that we do offer these free 30-minute consultations. You could check our website out online. We have a lot of great forms that you can download. If you go to roberthalltaxes.com, go to the right top corner, there's a forms tab. And if you're looking for real estate related deductions, if you're looking for entertainment industry related deductions, if you're that entertainment client or W-2 wage earner that invests in real estate or manages property, we service all industries. Real estate happens to be that industry that I believe that we can help out the most. because you have the ability to shelter and deduct expenses that a majority of taxpayers are not able to take advantage of. So very much keep aware of that. So once again, on top of the tax services, internal auditing, bookkeeping, payroll services, we incorporate businesses as well. So if you're thinking about starting an LLC or an S corporation, we can sit down and really consult with you as to what entity would be right for you from a tax perspective as well as a legal perspective. Most of the legal conversation will be with our legal team, obviously, because they're the attorneys handling the legal side, but we can also very much dive into the tax implications of each type of entity that you may be choosing or need to choose for your real estate investments or property management company. And so once again, kind of wrapping everything up on my end, and we're going to hop into the Q&A. I did want to leave you with obviously our contact information. The best way to sign up for this free consultation is just to text 72,000 to Robert Hall. Or take your smartphone device and wave the camera. So open up your camera like you're about to take a picture. And if you wave your camera over the QR code, it should prompt you. With most new phones in the last 10 years, it should prompt you to sign up for that free consultation. So once again, everybody at AOA, thank you so much for having me back. And I'm ready to answer these really important questions today.
All right, thank you so much. And if I could get the video here, that would be great. But yeah, thank you so much. Now, one of the questions that came up is, is there a form letter to send to the governor? And I just wanted to let you know we have the AOA magazine from this month actually has a letter from one of our members that they sent. So what you can do is just open up the AOA Today. It's the first article in the magazine. Go ahead and open that one up, and that is in there. What you can do is you can underline the parts that you really want the governor to see, and just tear out the whole thing. And even at the end, it has the governor's address, and you can send that to the governor and let him and be heard. And so this is super simple. You can do that. And so I just wanted to mention that. That's in the AOA magazine. If you're not a member, you didn't get the magazine, you can go on the website, AOAUSA.com, and you can actually get the magazine and print it out. You could print out that part there for you. And anyway, so just that's answering one of the questions that there was. Didn't I say that it was going to be a fire hydrant? And he totally is every time. And so lots of great information. So thank you so much, Tony. And here we go. We're going to start with the questions. And the way that we've always done it, if we have a seminar, we would just have people line up, and you could ask one question, and then you kind of go back to the end of the line, and then you can ask another question. So if you have asked a couple questions or follow-up questions, what my goal is to get everybody's question in before we go to the second round of questions. So that's kind of how we do it. If you are watching the live stream on AOAUSA.com, there is a little help, a blue button at the bottom. If you click on that, you can type your question in and they'll feed it to me. So questions are being fed to me. I'm not seeing all the feeds, but because they're coming from different locations, I'm being fed questions here. And so we'll go ahead and get started now. So we have Dennis on YouTube. Is there any COVID relief for loss of rents for rooms for rent businesses? COVID relief.
Yeah, so under COVID, there are many real estate related credit. The loan application, the EIDL, PPP. There's a lot of these relief support loans that are out there. As far as loss of rent is concerned, this is a very unique question. I get this a lot. The IRS looks at loss of rent as you not having to report rent that wasn't actually collected. So if you have a property that you own and 6 months was paid, 6 months wasn't, the IRS views that as a property that only needs to report the 6 months of rent that it collected. And so therefore you're not paying tax on 12 months of rent, you're only paying tax on 6 months. So as far as deducting the 6 months again as an expense, you're already kind of deducting it because you're not having to report 12 months of rent, you're only having to report 6 months. So there isn't any way to take the 6 months of lost rent and also add that as an expense deduction onto the return. And hopefully, I think that was the question that was asked. So hopefully that did answer the question.
Yeah, I think so. Thank you. And Kenneth on YouTube, how does the simplified home office deduction $5 a square foot affect personal home depreciation recapture?
Great question. That, you must know a little bit more about the tax code than the norm. Depreciation recapture is normally a set amount because you establish the depreciable basis on the depreciation recapture deduction. So under the simplified method, where it essentially takes this $5 per square foot or amount or whatever to offset self-employed income. If depreciation is a part of that, let's say that you set up depreciation 5 or 6 years ago, if the depreciation write-off is greater and it allows you to take a larger write-off than the simplified method, and this is something that we toggle back and forth with in the software program, and obviously we're going to take whatever is going to save you more money, but at the end of the day, the simplified method, if it's not allocating any depreciation against the write-off to offset self-employed income, then it would not be a part of the recaptured depreciation. Most individuals who own their home, remember, in order to take depreciation on an in-home office, you have to actually own the home that you work out of, right? You can't depreciate a property that you are currently renting because then you don't own that asset. So the in-home office deduction is really, the simplified method is really more for the individual who doesn't own the property. The individual who owns the property, there are a lot of unique tactics to use depreciation and other deductions to offset self-employed income. Now, to further answer this question, I just want to mention that when you sell a primary residence, you also have an exclusion on up to $250,000 of gain if you're single and up to $500,000 of gain if you're married filing joint. It's called the Section 121 exclusion, and in most cases, if you have depreciation recapture on an in-home office, normally it is absorbed by the exclusion that you receive when you sell the property. Now, obviously, if you've owned the property for 30, 40, 50 years, your gain is looking to be much greater than $500,000 or $250,000 single or married filing joint. So naturally, the recapture depreciation on an in-home office deduction would probably be a little bit greater and actually add income back onto your return. But once again, there are several moving parts to selling a primary residence, adjusting basis with improvements, the depreciation recapture on the office space side of things, and also non-recurring closing costs. So, to answer that question, it really, really all depends. I don't like to be vague like that, but it really all depends. I believe that whatever your depreciation is, if you end up selling that home, normally the recaptured depreciation would just be absorbed by the Section 121 exclusion, or adjust your basis down, still maybe increasing the overall gain, but still at the end of the day being absorbed by the Section 121 exclusion. That is a very long-winded answer, but it is a very actually, even though it's only a couple sentences there, a couple words, that's a very complicated tax question. So I feel more comfortable actually seeing a tax return and letting you know the breakdown of how that overall impacts if the property ever sells.
All right, next question. On YouTube, we have Lucy. If you allocate home office space, does that allocation offset your mortgage interest deductible?
I believe I understand your question, so I'm going to try to answer it as accurately as possible. If you have an in-home office deduction, you are taking a portion of your mortgage interest, a portion of your property taxes, a portion of your homeowner's insurance, a portion of your utilities, and then a portion of your home and depreciation against your self-employed income. So it actually is already, let me use numbers because this is probably an easier way to understand. If I have $20,000 in interest and I allocate $2,500 of the interest to the in-home office deduction and $17,500 to the Schedule A. Remember that the $2,500 is still reducing not only self-employed income, but it's also reducing federal and state income tax. So the total write-off that you have still is going to be $20,000. It's just $2,500 of that $20,000 is also offsetting self-employed income. That's probably the only real accurate way I can answer that question, because yes, you still fully get the full $20,000 write-off. It doesn't mean that you're only allowed $2,500 of it or only $17,500. It's just they're separated. Whatever the difference is of in-home office mortgage interest deduction, the remaining balance gets kicked over to your Schedule A and does not offset self-employed income. It only offsets federal and state income.
Great. Okay, here's one from Cheryl on YouTube. Can you legitimately set up an office in a room on the income property?
Can you legitimately set up an office in a room on a rental property? Well, I mean, your in-home office deduction would actually be set up in your own primary residence. I don't see why your corporation couldn't have an office space in one of your rental properties. That's a very unique question. I'm not going to say yes and I'm not going to say no, actually. I think that if it's your in-home office, that might be a little difficult to do because technically your in-home office would have to be inside of your home, right? So if you, let me give you an example, a very unique scenario, which I think would work in this case. If you live here in California, but you have business dealings in Texas, right? And so you actually have a physical location in Texas, but instead of renting out brick and mortar, you just want to use part of a rental property that you own as your office space in Texas. Right. Yeah. But you rent out the rest of the rooms, right? Let's say you have a family in there and you tell the family up front that, hey, this other room I'm going to keep locked. It has my office things in it. So I'm going to use this office whenever I travel to Austin or wherever in Texas when I'm doing business. In that case, yes, I could very much see an office space being inside one of your rental properties. But once again, a very, very unique situation and probably going to be a highly scrutinized deduction if the return is ever pulled for questioning. We'd have to see exactly the timing that you use the office space for in Texas to figure out not whether it's a tax write-off, but to figure out our argument or whatever leg we have to stand on in case that deduction was ever pulled for audit. So once again, I'm not going to say no, I'm not going to say yes on that. I think that it is possible, but it really all depends on the situation at hand. So that is a great conversation to have one-on-one with one of our senior advisors.
All right, here's one from Carol. Please explain the California $600 stimulus. How do you get that?
I believe that, gosh, there's a lot of stimulus payments. If you're talking about something that just passed yesterday, I have to be real honest with you, I have not read the full 6,000 pages. But if you're talking about the $600 PUA, the contractor unemployment, I believe that's what you're talking about. The contractor unemployment is based on you being self-employed. Contractor unemployment is not based on rental income or rental cash flow. If you legitimately have a self-employed business, under the CARES Act in 2020, the state unemployment fund was funded with federal government money to not only allow for increased unemployment benefits for W-2 wage earners who were laid off and furloughed, but also to create for, I believe, the first time in the history of the U.S., unemployment benefit for self-employed contractors. I can tell you right now that probably one of the most fraudulent things we've seen coming out of 2020 is individuals misrepresenting numbers on unemployment application forms to qualify for unemployment. I have to be real upfront with all of you that even though you might be getting checks from unemployment, it doesn't mean that eventually down the road that these unemployment claims won't be audited. I had some clients say that they applied for unemployment and I'm looking at the return and I'm thinking, well, they didn't have any unemployment income, but I think that because they thought or they were told that this was a relief plan for anyone who wasn't working at an office or some silly misinformation that was given to them, that they went online and they applied. And during 2020, there were a lot of people who applied and got it that shouldn't have gotten it. In fact, hundreds of millions, if not billions of dollars in fraudulently filed applications on both the unemployment side, the PPP side, and the EIDL side were filed, and the government was just cutting checks. And, we've all heard the term cut the check now, ask questions later, or, do now, ask later, or whatever that phrase is. I'm pretty sure that that's what California EDD is going to be doing. I mean, let's face it, EDD is at about 30 to 35% staff right now. Same with the IRS, same with the Franchise Tax Board. So when they become fully staffed again, there will be special programs put together to audit some of these claims. I can tell you right now, the PUA $600 unemployment benefit is really only meant for self-employed contractors, truly people who are self-employed who file Schedule Cs. There are ways that people have applied that have qualified for this without having those specific forms, and I'm a little worried as to what the back end result of that will be once California gets back up and running. But I believe that that's the number that you were talking about, $600 PUA contractor unemployment. It is very much available and a benefit to self-employed individuals, but once again, you have to file certain and specific forms on your individual tax return, like a Schedule C, in order to apply for that.
All right, thank you. And on YouTube, we have Rusty. What were the percentages for federal and state income taxes?
What are the percentage?
Yeah.
What are the percentages for federal and state income tax?
Yes.
That's yeah. I mean, yeah, so you're just talking about the ordinary brackets. I mean, the lowest can be as low as 10%, highest can be as high as 35%. It's 10%. 22%, or 10%, 22%, 24%, 32%, 35%. But remember that you're not focused on the marginal tax brackets. I want to make sure that you understand that. Marginal tax brackets are confusing to people because Marginal tax brackets are literally the grid lines that the government just throws out to the general public and says, hey, if you fall between this number and this number, this is how much tax you're going to pay, when that is completely false. See, you don't actually ever end up paying your marginal tax rate unless you literally hit one of those numbers exactly to the T. You actually end up paying something called an effective tax rate, which after all of your write-offs are taken into account, your business write-offs, your property tax write-offs, your credits that you get for children, your credits that you get for solar panels, all of everything kind of taken into account gives you this bottom line number, whatever you owe in tax, whatever the government's keeping. That ends up being your calculated effective tax rate. So just because you file in the 24% bracket doesn't mean that you actually pay 24% income tax. I know that this sounds kind of confusing, but if your AGI is a 24% AGI, understand that after all of your deductions and everything, 24% might be more like 10% because that is your effective tax rate. That's what you actually end up paying in tax. Perfect example, years and years ago when we heard that Mitt Romney had $41 million of income, but only paid 15% in tax. Well, it's because a majority of his income was capital gain and dividends. And at that point, the tax code said, well, if all of your income is capital gain and dividends, those aren't taxed at ordinary income tax rates. Those are calculated at just a flat tax rates for capital gain and dividends. So even though, hypothetically speaking, he was in the 35% tax bracket or 37% at that time, he actually only ended up paying 15%. So I don't want people focusing on the marginal brackets. I want them asking their tax advisors, hey, what is my effective tax rate? Not my marginal tax rate. What is the actual tax rate I end up paying because of every deduction we're taking on my individual federal and state income tax returns? So the brackets, you can Google them. They are changing with inflation. The brackets actually are, not the tax rates, but the brackets will be changing. And Biden's administration has not come out with the overall 2021 tax code just yet. And they will be changing things from what we've been hearing. Once again, this is all speculation at the moment, but for about $400,000 in overall taxable income and above, there could be some significant changes on the horizon for $400,000 and above in overall household income earners. So just keep an eye out for that. And like I said, once the new tax bill rolls out under the Biden administration, I'll be back here with a whole new PowerPoint explaining to you all of the changes that are happening in 2021 and 2022.
Great. All right, on Facebook, we have Conwall. Changed drainage system for units costing $18,000 and put second layer of roof on a property costing about the same. Can I deduct both of these entirely this year?
Oh gosh. Is there a way that I could see the question on the screen? Because that was a little bit hard for me to follow.
I hope we can get it up there. If not, I'll say again, he had a drainage and a system put up and also some roofing done. It looks like it was $18,000 worth, possibly more. Is he able to deduct all of that in a single year?
So if it is not a brand new roof, if it's just repairs and maintenance, absolutely. Qualified improvement property, like I mentioned earlier, though, is mostly interior improvements. Exterior improvements, anything that is deemed structural. And normally a roof has about a 10 to 15 year or even greater lifespan. And normally when you have a contractor that comes in and repairs or installs a roof and paneling and shingles or whatever you're installing, they'll actually give you a note that says how many years the roof is supposed to last, right? That gives you a good idea of what the government is going to view as the depreciation lifespan. But if it's just general maintenance and repairs, let's say that 500 square feet of the roof, or not 500 square feet, but let's say that a corner of the roof just needs to be repaired, and you want to put a draining system in there because that's where water tends to sit. That sounds like general maintenance and repairs to me. At that point, I would probably end up accelerating the write-off and taking it all in 1 year. Once again, that's a very specific question, so I don't have all of the pieces to the puzzle on that. But just to be very general in my answer, I probably would end up taking a majority of that 18 grand because it doesn't sound like from your question that is structural. It sounds like it's just improvements to better maintain the property. Like I said, if water's sitting in that part of the roof and that's what damaged the roof, so you're over there repairing that roof and then you put a draining system in there, that's not a depreciable improvement. If you didn't make that improvement or that maintenance and repair expense, part of your roof might cave in, or maybe it did. So that would be general maintenance and repair at a dollar for dollar write-off, not structural improvement, in my opinion.
Great. All right, we have Ginger on YouTube. How is a single member LLC reported on tax returns?
So
And is
single
there
member
a separate
LLC
tax ID?
Yeah, single member LLC should have its own identification number, and it's filed on Form 568 with the state of California. So you have your federal 1040, your California tax return, and then your single member LLC, which is a completely separate tax form that gets filed with the state of California to supplement the gross receipts tax filing fee as well as the $800 filing fee that the LLC files. So it actually gets filed with the individual return. It is a separate attachment in the electronic file, but it is not a separate tax return like a corporation return. It is literally combined with your individual return, and single member LLCs are due the same deadline, April 15th, as the individual income tax return. One thing that you want to be aware of when people start LLCs, they tend to not understand the full weight of an LLC on an individual return from a filing fee standpoint. So just understand that when you start an LLC, whether or not you have profit, whether or not you have property, whether or not you have business assets, if you gain, loss, break even, you will have to pay a parking ticket to the state of California to park your business in the state of California. So that ends up being $800 right out the gate, whether you made money or lost money, just for being a limited liability company structured in the state of California. If your gross receipts ranges over $249,999, let's say in gross rents under the LLC, you will also be subject to something called a gross receipts tax. And at that point, you have your $800 fee plus potentially a $900 additional fee up to $12,000 in gross receipts tax. So just be aware that when you start the LLC, sure, it's great for limiting liability, but there is also a very significant financial obligation that you tie yourself into with and a financial agreement with the state of California that you tie yourself into when you have that kind of filing. So just be aware of that. It gets filed with your individual tax return. Kind of a long-winded answer, but hopefully that gave you what you were looking for.
Great, thanks. And here's Mark on YouTube. Isn't it usually better to deduct actual expenses like gas, repairs, tires, and insurance on a 100% business vehicle than go to log and deduct mileage?
That really all depends. That might be the case on your tax return, but it's not the case on everyone's. So if your tax advisor is choosing to take actual car expenses versus mileage, that is because he found that it gave you a greater benefit. But as far as everyone's tax return is concerned, some people might not have any maintenance or repairs or even tire changes. I mean, the last tire change I had was because I did actually end up getting a new car last year. I mean, it's been years since I've had an actual oil change that one I've had to pay for because of buying it from a dealer and bringing it back and with the 100,000 mile warranty and everything. So there are certain situations where if you're maintaining a car actively, sure, your actual direct car expenses might be greater than the mileage write-off. I can tell you right now that in real estate, though, a lot of my real estate professional clients, they'll put 25, 30,000 minimum miles on their car. Maybe not in 2020 because of the pandemic and not really going very many places, but on an average year, they might put 25, 30 grand or 30,000 miles on their car, and 15,000 to 20,000 of those miles might be for business use. And at that point, at 57.5 cents per business mile on 20,000 business miles, you might be getting a 10, 11 grand write-off. And if you're sinking 10 or 11 grand into car maintenance, maybe it's time you buy a new car. That calculation is definitely something made by your tax advisor, so that might be specific to your scenario, but not to everyone's. And that is something that we'll have to toggle back and forth with to see which gives the taxpayer a greater benefit.
Great, thanks. Here's one from Tor on YouTube. Does the AGI of 150K include the unemployment received?
Yes, it does. However, as of yesterday, if your 150 is under if your AGI is under 150, including the unemployment, you can back out 10.2, but you can't be at 155, back out 10.2, which drops you below 150, that qualifies you for the benefit. So our software programs, because this literally just passed yesterday, our software programs aren't even updated with this particular change to the Internal Revenue Code. Remember, unemployment benefits are not taxable on the state side. They're not reported to the state of California. So nothing changes on the state return. It's on the federal return that they have to put a new box on the tax form that allows us to back out that unemployment benefit, or at least check a box that says, hey, make the calculation that allows us to take $10,200 off the unemployment benefit collected. But no, unfortunately, it's what I believe, and I just read this yesterday, so I'm hoping that I have more scripture on it as the days come. But as I read it yesterday, it is a cold cut off at 150. So up to 150, if you're $1 over 150, you have to figure out a way to get yourself below 150 because it's not 10.2 off of a number that drops you below 150, if that makes sense.
Great, thanks. And here's JC Harding on YouTube. It's 1031. Can you exchange an entire real estate property for a TIC in another real estate property?
For a TIC, well, I mean, it has to be real estate related activity. So as long as the TIC is owned in some sort of real estate investment trust or some sort of trust account, it is like kind in nature. It's rental investment. So if you have $1 million gain over here and you want to buy a rental property in Texas, as well invest in a REIT or a tenants in common, they're real estate related activities. So from my understanding, that actually does qualify. I know how it's all taxed, but you might actually want to run that by a 1031 exchange specialist. I'm going to say yes, because that's what I truly believe the answer is. But I would actually, if I was even confused about one single thing, I'd call our exchange specialist and just run that idea by him. From what I understand, tenants in common, because they're real estate related investments, those do absolutely qualify for the full-blown 1031 exchange benefit.
Right, and then also just to mention, next Thursday we do have, it's been a series, it'll be the third part in a series, and it will be on a 1031 exchanges, and it will be risk assessment in a 1031, but just like this will be live Q&A, so you can ask the question then if you'd like to. So, all right, so next question. Thank you, JC. Maria, how is the deferred rent reported in the tax?
How is the deferred rent reported in the tax? Well, I mean, I feel like this might go with the question that I answered earlier. If clients are not paying you rent for 3 or 4 months, let's say, you are not reporting 3 or 4 months of rent. Now, if they pay you back next year, or if they pay you back this year that 3 or 4 months that you didn't collect last year, I guess you have some options. I mean, if you wanted to claim it all last year because you were basically not in mortgage forbearance, but you were in rent forbearance, just hypothetically speaking, then you could have reported all last year and just paid the tax on it as if you had collected rent for all 12 months. But the way that it works is that if they end up paying you more rent this year than last year, technically it should be paying income tax on the full rental income that's being paid back in the year that you actually receive it. See, we are all cash basis taxpayers. And so there's nowhere on a tax return, that on an individual tax return, where we're able to put in rent collected, but for 2020's tax year. At least there's no box yet. With a lot of the changes that coming out of the CARES Act, with Biden's tax code being rolled out over the next couple months, our software programs will update to allow certain input items. Just like with the perfect example, the $100,000 withdrawal from retirement plan, we are able to spread that out over 3 years. So there's a whole new section in our software program that allows us to either elect to spread it out over 3 years, penalty-free, or to elect to pay it all in 1 year, penalty-free, or elect to pay it over a certain period of months, therefore limiting the amount of tax based on how much you want to pay back before certain deadlines. So that isn't available for rental properties just yet. I'm not assuming that it won't be, but at the moment, if people are paying you 4 or 5 months of back rent in 2021, technically that would be reported on your Schedule E for 2021, because there was no loss of revenue at that point, was there? Right? Because you're being paid back all of the money, and so you're being made whole a year later, but at the end of the day, you are being made whole, which is a win in itself. You know, if they didn't pay you at all, that's a complete loss for you. And so you can't deduct it as a loss. The benefit in this case is that you didn't have to report the income, so therefore your rental property should have showed a larger loss, right? So instead of showing 12 months of rent, you showed 6 months of rent. So that should have pushed your rental property into a greater negative, which then the negative was offsetting your other like-kind income, and that's where the overall tax benefit was. So once again, if it's all being paid back in 2021, technically and hypothetically speaking, that would be all taxable in the 2021 year, not 2020.
Great, thanks. And here's Lisa. She missed the seminar. And so, Lisa, I just like to say that with this seminar, you can just catch it again. Go to YouTube and just search AOA USA. And we have a whole bunch of seminars. You may have missed a bunch of them, and they're all there. So you can take a look and see this seminar again and catch it from start to finish, get the whole presentation. But we will still ask your question. Here's her question. Can I deduct loss of rent, due to tenant using COVID as an excuse? Can I deduct unpaid rent as an expense? So you can maybe make it, I know you did answer this specific question before, but maybe just make it a quick answer, and then we can go on to the next one.
Sure. So if you rent out a property for 6 months and then the remaining 6 months of the year you didn't collect any rent, the benefit for you, or not the benefit, but the loss that you're actually taking is only having to report 6 months of rent, not 12 months. So if you only reported 6 months of revenue and you deducted 6 months of rent that wasn't received, you'd actually be deducting it twice, right? Because you're not claiming it in the first place, and if you're trying to deduct it, you're actually creating a much larger spread or loss for yourself. So the actual tax way of reporting it is the fact that you don't have to report the full 12 months of rent because you only received 6 or 7 months of it.
Right. All right, on Facebook, we have Darius. If I rehabbed a house in California in 2019, 2020, then sold it in 2021 and exchanged it for a property in Washington State, how can I preserve the tax-deferred status? I had no income in 2019, 2020 and took no depreciation and didn't deduct any expenses.
Okay. So you can only 1031 exchange business property. So it would have to actually be set up as a rental investment in order for you to qualify for an exchange. You can't just buy a property, improve it, and then sell it on a short-term basis. So rental property, 1031 exchange property, has to be long-term investment. If you never collected rent for it, if you never attempted to rent it out, if it never showed up on a Schedule E, it would not qualify for a 1031 exchange. If you did set it up as a Schedule E, collected a couple months of rent for it, but held it for more than a year and a day, yeah, it potentially could qualify for an exchange, but the only way to do that is for you to actually exchange, cycle the profit back into another like-kind investment anywhere in the U.S., to be real honest with you. But I think the trouble that you're going to run into is that if you didn't take any depreciation on the property, technically it wouldn't be considered a 1031 exchange qualified property, because one of the major parts of a property that can be exchanged is depreciable basis. And so that's something, there are a lot of missing parts. There's a lot of different parts to that question that different requirements that need to be met in order to qualify for an exchange. And one of those is that it has to be a rental property. And make no mistake, the Internal Revenue Code is written very specifically to state that if you at any point decide to rent out a property, depreciation must be taken. Do not mistake this. The Internal Revenue Code says that when depreciation is allowable, which is on any long-term rental investment, it's allowable, it must be taken. You cannot elect not to take or waive the depreciation write-off. And let me put it into this case. If you never took depreciation over 15 years of owning a property, and you were supposed to, when you sell that property, guess what? Whether you took the depreciation or not, the government in an audit would add back the depreciation and force you to pay tax on it. So depreciation, when allowable, must be taken.
Great. Here's Helen. What's the advantage of an LLC? Do you have any details?
Only legal benefit. LLCs only create legal asset protection and absolutely zero tax benefit under a limited liability company. Sure, the LLC can elect to be taxed as a corporation like an S Corp and receive tax benefit under an S Corporation, but an LLC straight out the gate is only for limited liability protection. It provides you absolutely zero tax benefit.
Great. Okay, here on YouTube we have Rob. You mentioned a 1031 exchange could reset depreciation if it was used up. How does depreciation work if you still have some left when you acquire the replacement properties? If the replacement properties are greater in value, will the depreciation deduction increase?
Yes, absolutely. You just hit it right on the nose. So when you go from $1 million property to a $1.7 million property, and let's say you still have remaining depreciation on the $1 million property, your accountant adjusts the basis in the new property to make up for whatever depreciation recapture is being avoided, right? The amount that you're not paying tax on, and we take the remaining depreciable basis in the first property, add it to the increased basis in the new property, and now you have increased depreciation write-off in the new property. That's called an up-leg exchange, because you're going from a lower price property to a higher price property, which means that you'll have more building value to depreciate. So yes, it does actually increase your overall write-offs.
All right, on YouTube, Monica, what does it mean to treat a property as non-passive?
So passive versus non-passive elections means that non-passive essentially, and I don't want to give you like the exact verbiage out of the Internal Revenue Code. To be real honest with you, I'd have to look it up myself. But non-passive, from an easy to understand standpoint, non-passive means that you are essentially actively participating in the property, meaning that you do not have a property manager in place. You do not, the property is local to you. It's not halfway across the U.S., meaning that you are actively participating in that real estate related activities. Most real estate professionals will make all of their rental properties non-passive, especially and specifically if they're close to where they live. If I'm a real estate professional here in California and I own properties in New York or in Florida, more likely than not, I cannot make that a non-passive activity because I don't actively manage those. I probably have property managers. But I can make the real estate professional election, which could allow me some of the real estate loss benefits because I'm a real estate professional. I meet all the qualifications to make that election. Passive would mean that you're just collecting a check, essentially. In most cases. So that's probably the easiest way to understand the election. There's obviously a little bit more detailed breakdown that I'm not going into, but non-passive versus passive, and the non-passive election actually allows you to deduct certain loss expenses to offset income, whereas passive might suppress some losses and carry them forward to future years. So non-passive is going to give you the much greater tax benefit. Just from a bird's eye view, passive will not give you the greater tax benefit, but don't just go checking boxes to see what gives you the lower bottom line. You need to understand why you are checking the non-passive versus passive, and your tax advisor should absolutely be able to answer that question specifically based on your industry. Like doctors, for instance, they wouldn't be able to check non-passive on the rental property. The real estate professional, the property manager who manages the properties and owns the properties, yeah, non-passive election would make sense at that point. So active participation is a big part of the non-passive versus passive elections.
All right. I told you guys he's a fire hydrant, right? We keep going here. We got a lot of questions. I don't know if we're going to get through all of them. Here's Kyle. Oh, no, Victor. No, yeah, I'll do Kyle. Approximately what percentage of Schedule E filers do you see report income versus loss on rentals?
Oh man, I mean that's kind of a loaded question as well, because on rental properties, depending on your depreciation, depending on mortgage interest, depending on property taxes, improvements, on paper, normally rental properties in the first 10 to 15 years will show losses because there's maintenance, there's repairs, there's depreciation, mortgage interest, property taxes. So there's a lot of expenses to offset rental income. But something that's unique about the new age rental property investments like Airbnb and VRBO, you're able to capture a lot more rental income in a shorter period of time because you're charging a premium, especially during times of a pandemic, for people to stay in your rental investment. So coming out of the pandemic, it actually is less losses that we're seeing and more overall gains. But I guess it really all depends on the type of clients that accounting firms service. We service all rental property investors, short-term, long-term, flippers, property managers. We service everyone. So when you ask for a percentage of rental properties that show losses, I'd say a majority of them do, because a majority of people have debt on their properties. For people who have paid off properties, those aren't going to show losses. Those are showing cash flow, right? So that's the big difference, is whether somebody has debt and or if the property has been fully depreciated because it's been owned for more than 30 years.
Awesome. Thank you.
Mm-hmm.
Okay, I'm using my home office to manage 5 rental properties and another business. Do I take 20% of the total home office expense to each property on my Schedule E?
No. So you have to plug in the figures on the in-home office deduction and take it based on your square footage versus overall square footage. So let's say that 30, 20, or let's use 20%. Let's say that 20% of your home is your office, and 20%, let's say, calculates out to be a $8,000 write-off. You take that $8,000 write-off and you figure that $8,000 is going to be spread out over all of your rental properties. It's not $8,000 per property. It's $8,000 total for the write-off, and depending on how many properties you have, you can spread it out on the tax return amongst the rental properties as your office space.
All right, thanks. And on YouTube, Victor, is a virtual office space deductible?
Virtual office space. Well, I mean, yeah, any office space that has expenses, that is a legitimate office space that's used for operating a business, any expenses that you incur would technically be a write-off. But once again, it all depends, because if you're talking about square footage or if you're talking about actual office expenses, desks, chairs, filing cabinets, computers, monitors, things like that, they're deducted differently. So it really all depends. And remember that I didn't mention this earlier, the in-home office deduction is not a write-off for every self-employed individual. If your business is already showing a loss, let's say you generated $20,000 in self-employed revenue and you had $30,000 in expenses. If you're showing a $10,000 loss, guess what? The in-home office deduction is not a write-off for you, because the in-home office deduction is only written off to the extent of profit earned. meaning that if your business is showing a loss, you do not get the in-home office deduction. So understand that even though you're putting it on your return, and if it has a high risk for audit, but you're already showing a loss, it's not saving you anything. So why put a deduction on your return if it's not saving you anything? Well, my argument is that it's to create, one, a template with the IRS to show that you actually did have an in-home office. So when you do return to a profitable number, that you have that consistency from year over year, number one. Number two, California still allows for the write-off for W-2 wage earners and such. So, but for self-employed individuals, if you have no profit, the in-home office deduction is not a write-off because it only is deductible to the extent of profit made.
Great. And Marciela on YouTube, what's the difference between LLC, living trust, etc.?
So I mentioned that earlier, and if you want to watch the webinar over again, you can see the more detailed breakdown. But just a bird's eye view once again: LLC, S corp, trust, insurance, and corporation. Was that the question, or was it the different types of entities? It was
LLC and a trust. How are those different?
Got it. So a trust protects you from probate. So it handles protection with the state side, and an LLC handles liability protection. The legal differences between the two probably better answered by an attorney. I know a bird's eye view explanation of how those both work, but a probate, not sale, but a probate situation, a trust is going to be the go-to protector against probate in the state of California and any other state that you own assets in. As far as the LLC, it's meant to limit liability on business assets. So the way that you properly have it structured is that you don't own the property anymore. Your LLC owns the property, and you don't own the LLC. Your living trust owns the LLC. So if somebody sues your property, they're suing the LLC, not you and all of your personal assets. If they're not able to pierce that corporate veil, great. That's great asset protection. Let's say I pass away, my properties catapult, or my LLC catapults into the living trust, and therefore my heirs, my next of kin, my spouse, don't have to lawyer up at the point of my death or passing to fight the state of California for all of the assets that I've worked my whole life to obtain.
Great. And also Ken Ziskin, if you look at the AOA USA video library there, it's on YouTube, and it's also in your member portal. If you go in there, there's videos. If you go in there, and you can find live stream that he's done, and you can look at that, and I think he'd go into much detail on that for you. And let's see, we have Rafael. Good morning. How do I get at those that owe us so much money and that are bankrupting us? And so, we talked about, at least legally, we need to advocate. We all need to do it to get our rights back. But if you can contact an attorney, and depending on what state the people that owe you money are in, whether they're still in your apartment or not, and whether they need to be evicted or not, you could look at the eviction attorneys. If you go on the AOA website, there's the AOAUSA.com. There's a contractors and vendors link, and just look that up, and there'll be a whole bunch of attorneys. You probably need an attorney for that one. And let's keep going along here. Okay, Slava, can we deduct permit city fees for retrofit or ADU in 1 year?
Permit fees? Yeah, license and permit fees you can. The ADU units, there are ways to accelerate the write-off on the ADU unit itself. Once again, very unique part of the Internal Revenue Code. If we can qualify the ADU unit and a majority of the structure itself as qualified improvement property, that'll be 100% tax deductible. There might be structural things that have to be depreciated over 15 years or 27 and a half years, but a majority of that will be dollar for dollar tax deductible. The licensing fees, the permitting fees, business fees, those will be dollar for dollar adjusted against income. Now, retrofitting is a little different. Sometimes retrofitting, depending on the cost and the overall retrofit improvement, sometimes that has to be depreciated over a certain lifespan. But specifically to your question about licenses and permits, those in most cases, I don't see why they would ever not be dollar for dollar tax deductible unless there was something specifically unique about that particular license or fee, like blueprinting fees. If your blueprint on a commercial building, $100 million commercial building, if your blueprint expense is like 80, 90 grand plus, probably even more on a $100 million project, that might actually get built into the depreciable basis of the building. For smaller projects like ADUs and improvements to current homes, residential homes, I would take licensing fees and permits dollar for dollar. There's actually a box on your Schedule E specifically noted for licenses and permits.
Great. All right. On YouTube, Living Good. I like the Realty Group. Here we are. What is the difference or benefit between selecting Safe Harbor versus QBI? I know QBI has a 20% benefit, but how does that compare to Safe Harbor?
Well, if I'm not mistaken, Safe Harbor doesn't give you a percent of your income that's non-taxable. The Safe Harbor rule is essentially allowing you to accelerate certain depreciation write-offs and sometimes even or make a grouping election on your return to make all real estate related activity one activity. It's filed with a 3115 form, which was actually required under, I think, the second to last year or last year of Obama's administration. And because it was so confusing to the general population of accountants, they removed that 3115 election. So making the Safe Harbor election, if I'm not mistaken, is not nearly the same thing as the QBI deduction. The QBI deduction actually allows you, in certain instances, to take 20% of your property's cash flow and not pay tax on it, depending on what your overall taxable income threshold was. So, I hope I'm not confused by your question, but I believe that there aren't really too many comparisons between Safe Harbor and the QBI deduction, or at least I haven't seen any comparisons, because Safe Harbor does not make 20% of your cash flow tax-free.
Okay, great. And on YouTube, we have Saeed. Does each rental property have a separate Schedule E form, or multiple properties can be reported on one such or Schedule E form? So
for instance, a fourplex or a triplex would all be on one Schedule E. If you have two properties on one property, so 706 West Street, 706 and a half West Street, sure, you could set those up on two different Schedule E's, or you could group them on one. If you have two properties side by side, two completely different addresses, two completely separate parcels, they would need two Schedule E's. So it really all depends. I've seen people break a fourplex into four different Schedule E's. I don't see the necessity for that. That just means that you're going to pay more to a tax advisor because there's more forms that get filed. But if you have anything that could potentially be sold separately from each other, meaning that if I have a fourplex and I divide it into four different sellable units, right, then technically those should be four Schedule E's, because at any given time I could sell one of the units and keep the other three, right? So I would need four Schedule E's, because once one is sold, I still want to have the depreciable basis for the other three that are left over. Normally, the better protected you are, the best protection structure would be an LLC for each one of your rental properties. The conversation kicks in only because of the California side being the most expensive filing fee in the U.S. at $800 per LLC. A lot of people don't want to have individual LLCs, individual Schedule E's per property. But great question. I think that it's not necessary in most cases, but if they are truly separate properties and separate addresses, whether they're parcels sitting right next to each other or parcels 50 miles away from each other, yes, those should be two separate Schedule E's.
Great. All right. And on Facebook, we have Arturo. Can you partially 1031 exchange a property where I just take most of the proceeds for an exchange, but some of it not?
Of course, it's a partial exchange. So whatever you access as far as cash out of that exchange is concerned, you pay tax on. And that allows you to control the amount of money that you're actually deferring into the new investment and the money that you're taking out and paying tax on. You see this as being a very popular thing when people are trying to pay off their primary home debt, paying off credit card debt, paying off student loan debt. So they do the exchange, but they only access a certain part of the profit and pay tax on it, but use it to pay off personal debt or whatever they want to use it for. But yes, you can do a down leg exchange, you can do a partial exchange, or you can do a full-blown exchange. There are many options in the 1031 exchange, part of the Internal Revenue Code, section 1031.
And literally last Thursday, we covered partial exchanges. So go to the search on YouTube, AOA USA, and literally it'll be like the second video you see there. The first one will be the one that you're watching, and the next one that has already been done, it will be about partial exchange. Oren did a great job going through that. So take a look at that one. I think that'll be a good resource for you. Okay, Paul on Facebook. Can you elaborate on how one qualifies to be a real estate professional? Do hours count as a licensed realtor?
Well, sure. I mean, it's 750 hours actively managing or participating in real estate-related activities. Obviously, a realtor who practices what they preach when they buy rental properties, the 750 hours active participation is the easy one to meet. And then the 51 rule kicks in and says that 51% or more of your income has to be real estate related activity income, which is great. And then 51% or more of your time has to be actively working within the real estate industry, which could be rental property management of your own properties, real estate commission income. And so at that point, your real estate professional election would be grouping all of those activities into one play. Where it wouldn't work is if you were an accountant like myself and I also own rental properties, and let's say that I even manage those properties. Sure, I might be actively participating in those properties, but if I individually make over $150,000 in adjusted gross income, or me and my spouse collectively make over $150,000 in adjusted gross income, the 51% rule, because I make more money doing tax preparation than managing my properties, I would not be allowed the real estate related loss deductions. I'd be allowed my expenses to the extent of rental income collected, but any losses, I don't lose them, I just can't use them. And so I, in particular, with my rental investments, I'm not allowed loss deductions on my real estate related activities, but I carry them forward to future years because I have to suppress them as my income or my adjusted gross income is above the phase out threshold of $150,000.
Great. We're on a marathon here, and we're almost done with the first round of questions, so we'll probably stop after that. But we have Metro Pepper. Is there a ceiling amount for an up-leg exchange?
Is there a ceiling amount for an up-leg exchange? I don't believe so. I've never heard of anybody not being able to exchange a high-valued property. So, and in fact, the wealthy of America, they tend to utilize 1031 exchanges more than anyone else because it defers the tax on their large investments. So by ceiling, I think that you're trying to ask if there's a max that you can exchange. And no, I don't believe there is.
Right, and then you can ask that question next week again. They're going to cover 1031 exchanges again. They have a 4-part series on that. It'll be the 3rd part. So go ahead and ask that question next week to get a definitive or ask it the question a little different if that didn't answer the question for you. Guatam, on Prop 19, we are over 65 and buy a home near our children. If we rent our primary home and sell before 2 years, can the property tax base can be transferred to the new home?
So I'm an income tax professional, so I'm not a property tax professional. Yes, I can answer the capital gain question. As far as the transfer of basis, that would be a better question for somebody who deals with property taxes. But yes, I mean, if you lived in the property 2 out of the past 5 years, you'd be excluded from up to a $500,000 gain on the sale of that property, even if you rented it out for the last 3 years, because you still lived in it 2 out of the past 5 years, right? So even if you don't live in the property when you sell it, you would still be able to qualify for the Section 121 exclusion, which means that you defer the overall capital gain on everything. Now, I believe that you have to be, and once again, don't quote me on this because I'm not a property tax specialist, I believe that you have to be living in that property in order to do the transfer of property tax base. Because property taxes and income tax, they're 2 completely separate worlds. And any property tax questions, I usually just pick up the phone and call the county assessor's office and ask those questions directly to somebody who works there. They're incredibly knowledgeable in all of that, by the way, and very helpful in getting us those answers. But I believe that with the property tax side of things, you have to physically be living in the property in order to transfer the property tax basis. Now, if not, then it would probably fall under the same rules as the Section 121 exclusion, where you at least had to live in the property 2 out of the past 5 years, which still stipulates it as a primary residence sale. But I believe that on the property tax side of things, it has to be your primary residence in the year of sale for you to transfer that property tax base.
Okay, great. And here's Brian Ho on YouTube. Can you exchange the method or deduct car expenses? You use actual expenses for the beginning years to use all the depreciation, then you switch to mileage method after that.
Sure, you don't have to stick with one method. You can always change methods. You could even change cash to accrual methods and accrual to cash methods. I mean, there are a number of elections that can be made to change the method of most things on a tax return. In this case, it would just mean you calculating whether or not the direct expenses outweigh the actual mileage deduction, which gave you more of a benefit. So yeah, you can switch it back and forth. Once depreciation is done on the car, you really have no other write-off. And if you didn't get a new car and depreciation is gone, your only option is really direct expenses on the car or mileage. So yes, absolutely, you can switch it up.
All right, here's Steve. You mentioned an LLC is only for legal protection, not for taxes.
Mm-hmm.
However, doesn't an LLC give you an approach to pass on your property tax basis on rental property to your heirs post Prop 19?
So once again, you're talking about property taxes and income tax, two completely separate worlds. So that was a misunderstanding in what I said earlier, maybe, because the income tax benefit is something completely different. When you add children to title, yes, they might be inheriting the property tax base as a gift when you add people to title, but what you're giving up is the Section 121 exclusion and or the stepped up basis on the property investment itself, meaning that if I add a child to a rental property title, when I die, my children inherit my basis, which sure, that might work for property taxes, but as far as income tax is concerned, they actually inherit my basis. If I bought that property for $100,000, now it's worth $2 million here in Burbank, let's say, at that point, you're passing on your capital gain tax liability and recapture depreciation liability to your kids if they ever sell the property. So the main benefit, actually, in my opinion, this is just my opinion. I don't want people to argue with this because we all know what opinions are, right? So this is my opinion, that the capital gain implication and the tax savings for the stepped up basis at the moment is much greater than the reassessment of property tax if you are planning or your children are planning on selling the property. Obviously, if your children inherit this property, they never plan on selling the property ever. And they're only going to 1031 exchange, which after you're gone, you won't know what they do with the property, right? But let's say that your kids say, Dad, Mom, I'm going to keep this property until I die, and I'm going to leave it for my kids. Well, if that's the case, then yeah, sure, add them to title. What's the point of not having them on title because they never plan on selling the property? So who cares about what basis they inherit of yours? But if you have an idea that your kids are going to want to move out of the state and take that money and buy other rental investments, going from that one Burbank property into 15 units elsewhere in the U.S., you might actually not want to put them on property, on title, allow them to receive the full stepped up basis in death on the property, sell the property tax-free, walking away with a couple $1,000,000 in their pocket that doesn't pay any tax, and now they have an option to go and take that money and buy their own investments. See, I found that more likely than not, children will sell property, even though they look you straight in the eye and they're telling you that they're not going to sell the property. There is something about that property that carries an emotional sense to it, right? It wasn't their property; it was your property. It was their parents' property. And so, most real estate investors, people that have been around a long time and who were taught this, they can look past that. But what you're doing by adding children to title right now because of this Prop 19 mess is something that's giving up a good portion of the income tax benefit on the back end. So before you start adding people to title of LLCs, before you start adding them to title in general, you need to sit down and map out the tax implications of all of it. Not the property tax implications, but the income tax implications of doing so. Two completely different worlds, okay?
Great. Well, Tony, thank you so much for your time and just answering all these questions all the way into lunch here. And thank you, everybody, for joining us. Did you have any parting words, Tony, before we wrap it up here?
You know what? I just wanted to once again thank AOA and Dan and Jeff and just allowing Robert Hall and Associates to be be a part of such a unique and great thing. We love what you've built for many, many years here at AOA, and we just feel very privileged and honored to be a part of it. So thanks again. And thank you, everybody, for logging in. Mm-hmm. Stay safe out there, okay? And we'll talk soon. And thank you. I mean, 500 5-star Google reviews, it's hard to argue with that. And also, if you want to join AOA, remember there's a 100% guarantee. We guarantee that you'll be happy with that we're going to be able to give you money-making ideas or help you save money, and we guarantee that we're going to make it the process of providing housing easier for you. So definitely join AOA if you haven't, and tune in next week. Go ahead, hit the subscribe on the YouTube and the Facebook, and sign up for our e-newsletter, and we're going to keep you in the know and hopefully keep you out of trouble too. Thanks a lot, guys. Bye-bye.